Why SPACs Crash is the title of today's presentation. And if you're somebody that's invested in SPACs or thinking about investing in SPACs, then you want to watch this because we explain why SPACs have performed so horribly over the years. Now, the reason that we did this presentation is because a lot of people are asking questions about SPACs. Here you can see some of them. So are SPACs good? No, generally speaking, they're horrible. Will SPACs crash? Yes, they have and will continue to. Are SPACs risky? Absolutely. Are SPACs worth it? No. Where you can trade SPACs, will SPACs survive a recession? Well, we already know the answer to that. No, as they're increasingly going bankrupt. Are SPACs good investments? No, they're not. And this last question here I quite like. Can SPACs go below $10? Oh, yes, they can. And we're going to answer that a little bit later in this presentation. Now, in 2017, so that was around 6 years ago, we wrote this piece, an intro to, and that was almost 6 years ago to date, an intro to blank check companies and SPACs. So if you're not familiar with how a SPAC works, this is similar to your bog standard reverse merger. So a sponsor will go out and find institutional investors to raise money. They will put that in a shell company that then begins trading, and then they'll go out and find a firm to acquire, and the sponsors make out like bandits, the institutional investors as well. The founders of the company that's being acquired love it because they get to go public, and they get a lot of capital generally for very little work, and the retail investor gets screwed. So the points we made 6 years ago, people seem to be desperately seeking a way to circumvent the traditional startup capital raising process. That's one of the reasons ICOs were so popular. The truth is that venture capital firms have created the entire world of technology as it exists today, and they're quite good at figuring out ways to exit their positions. And the IPO process has managed to act as a gateway for valid companies to become publicly traded. That's where VCs exit. So that combination of venture capitalists vetting companies and the public markets allowing them to become publicly traded at a particular valuation has worked quite well. Given the track record of performance, the venture capitalists and the investment bankers who gatekeep IPOs are probably the best people to decide where investments should be made in technology, not the retail investment community. So how it started out was that a SPAC would have an initial public offering. So that's the shell company that would allow investors to buy shares of a pool of cash. So the cash would typically represent about $10 a share. So that's what the price ought to be. However, what was happening is that rumors were being spread that the SPAC was going to buy a particular company, and the rumors would send the SPAC rising 30, 40, 50%. And then the SPAC might confirm the purchase of that company and release a glossy investor deck. And without the deal even closing, shares would rise even further. So what essentially would happen is that the real value of those shares was always $10 a share until the SPAC deal was signed. And then it fell because what was being acquired wasn't even worth $10 a share. And that's because there weren't gatekeepers to assess the pull them out of the air valuations that were being ascribed by sponsors to SPACs. So this is what we said 3 years ago. At some point, the red-hot SPAC market is going to have a reckoning. And the article that we published at that time was titled, I'll put a link to it in the description of this video. It said, SPACs do retail investors no favors. So everybody else made out on the benefits of a SPAC while retail investors got screwed over. So from that same article 3 years ago, we took a look at the performance of the 4 stocks mentioned, and here's how it looks. Velodyne is down 94%, and they ended up being acquired at 87% below the SPAC debut price. Remember, we're talking about 4 companies we highlighted in that piece we wrote warning retail investors about SPACs, and these were just 4 examples. We're not even talking about how much down the share price is from the all-time highs. This is just down from when we warned retail investors 3 years ago. Virgin Galactic down 84%, Hyliion down 96%, and Nikola, whose founder was accused and indicted and I believe settled with the SEC for a paltry $125 million of fraud, was that company, Nikola, is down 98%. Put that in perspective. If you invested $10,000 in Nikola, you'd have $200 left today. So as we said back then, the only losers in this story are retail investors. And what we can do is look at the broader universe, not just these 4 examples. And what I've done here is pulled up the Nanalyze Tech Stock Catalog. So this is something that our premium subscribers have access to. It's an Excel spreadsheet with 460 stocks. And what you can do here, there's a field that you can filter on called SPAC, and you choose Y for yes, and it will pull up about 92 SPACs. So we covered 99 disruptive tech SPACs since they first started coming out, and those are all reflected in this catalog. So what you can do is filter yes there, and then very quickly start to assess performance. Now, for those of you watching this that want more of our content, just go to our website, nanalyze.com. You can go to subscription plans just up there at the top and click that sign up for free button. Give us your email address, and then you'll receive up to 4 premium research pieces that we produce each week. You'll be able to access 4 free per month. We produce about, let's say, more along the lines of 3 or 4 every week, and you'll get access to our standard newsletter. So that's one way that you can support us. I'll put a link to that in the description of this video in the comment section as well. But for those people that are premium annual subscribers, you can access that catalog. And as I said, we looked at 99 SPACs. We invested in 1 and 2 we like, so that we found 3 of 99 to be favorable. Of that universe of 99, 5 have already gone bankrupt. Several were acquired at a loss for shareholders, and that leaves us with about 91 SPACs in that catalog. I was just looking, it was 92, but it's now 91 because 1 went bankrupt. One of Virgin's SPACs went bankrupt. So if we look at the 91 SPACs left in our catalog, first of all, we can consider this. If you purchased equal amounts of each of those 91 SPACs at the offer price of $10 a share, you'd have lost 60% of your money today. So that's where that sits. That's what a portfolio of disruptive tech SPACs has done. 16 of those 91 have lost more than 90% of their value. 45 have lost more than 75% of their value. And 67, or roughly 3/4 of these SPACs, have lost 50% or more of their value. Remember, this is important. Most of those SPACs we're talking about soared way above the $10 asking price because of the meme stonk moron type. So people, retail investors, bag holders, ended up losing huge amounts of money. And who was on the other side of that trade? Institutional investors. So when Chamath was out there championing SPACs, the father of SPACs, talking about how he was democratizing access to wealth, he was pissing on your shoes and telling you it was raining. So when we look at that catalog, at all SPACs that trade above their offer price of $10 a share, we have this list of 7 companies. So and I've included in our catalog, what's kind of neat is that we have this notes field for 460 stocks with brief comments on every single stock in that catalog. And there's a notes date. You see that on the right, so you can see the last time we left that comment. We'll go through there and try to update these so that they're more frequent where we see fit, although most of these comments are still relevant. So let's go through them real quick. IonQ, we've written about them, published videos. This has because of people that pump these stocks, that do these companies no favors, they've pumped this valuation that's out of this world in terms of how heavily hyped IonQ has been and continues to be. You have Circle, just way too risky. We wrote a piece on that. FO Charging, I crossed this out. I don't think the SPAC went through. So that was another, as I mentioned earlier, what could happen is that these SPACs could get all pumped up and then the deal might not go through. And what's that SPAC worth? Well, it's worth less than $10 a share, actually, because you have transaction costs and things like that. People need to get paid. So this was a SPAC deal that never went through. We'll adjust that in our catalog. We update this catalog every month. And below that's Livewire. So that was Harley's electric motorcycles, which never really took off. We don't think that they ever will. We're not bearish. We are bearish on the entire electric motorcycle thesis. Scooters, that's a different story. But electric motorcycles, people ride a motorcycle for a reason, and it's not because it's electric. Then you have Enovix. We've written about this recently, actually, and they're supposed to have $176 million in revenues this year. It doesn't look like that's going to happen. Again, this company is, everybody's waiting for these batteries to start selling, and they'll continue to wait. And as soon as they have meaningful revenues, we'll come back around for another look. You have Vera Mobility. This is an interesting one that's actually maybe even worth another look because it seems to be faring well. It was interesting the first time we went around, but our idea here was that with vehicle autonomy on the horizon, do you really want to be investing in a firm that collects fees for tolls, parking, and traffic violations? Probably not. So in the long-term thesis there, it doesn't seem overly compelling. Then you have Symbotic. We love the warehouse automation theme. We're invested in that in other ways. But serious customer concentration risk here and, of course, hype. But Walmart, I think it's more than 86% of total revenues the last time. Well, here this is comments quite recent. So Walmart was 86% of total revenues in 2023. Walmart is the 500-pound gorilla at the negotiating table, and this company gets to have very little leverage. So to answer that question we asked at the beginning of this presentation, why SPACs crash? So 6% of the 99 SPACs we covered are above their offer price. In other words, 94% of all the disruptive tech stocks that we covered are below their offer price. That's because no institutional vetting process was in place. Sponsors made out like bandits. That was the easiest money they ever saw. Founders, they raised easy money. They went public too easy. That money was too easy for them, and some of them blew right through it. Retail investors, they footed the bill. And guess what? People like Chamath, who sits out there and is not being held accountable for what he did, and recently he was in a spat on Twitter and talking about, well, you should have sold when I sold, or some bullshit excuse. And again, you say, well, people should be accountable for their own investment decisions, indeed, but he should also be held accountable for what we were able to call early on as total BS. And whenever somebody tells you they're democratizing access to wealth or capabilities when it comes to investing, be very suspicious. Robinhood's another company that we don't look highly upon at all for that reason. They suggest investors get involved, and that's where they make their money, in options and crypto. So there are potentially there's potentially some value to be had here, and our community and our subscribers have raised questions around. I think this sums it up. Now that SPACs have fallen so much, are any worth picking up? And that's the title of this article. I'll put a link to it in the description of this video. And what that does is it looks at what venture capitalists were willing to, what valuations they ascribed to these companies when they were willing to invest in them, and then what the current valuation looks like today. And then we look at the discount there. So if you're able to invest in some of these companies at less than the last round that they raised, then that's a pretty good deal, right? Well, maybe not. And that's this next article that says, avoiding value traps and beaten down SPACs. One word of warning here. Don't even think about investing in a SPAC unless they've achieved meaningful revenues that show product market fit. So to conclude, the takeaway here is that people who say they're democratizing access to wealth are doing anything but. So that's a big learning lesson from this. The IPO process that ICOs tried to skirt and SPACs did as well, it's key to vetting a business before listing, and it works fairly well. Reverse mergers, these are one of the oldest tricks in the book, and for decades we've seen companies that shouldn't be publicly traded go public using reverse mergers, usually on the over-the-counter markets, those SPACs. That was the evolution of this same sort of behavior onto more major markets. SPACs should deservedly be viewed with suspicion. Look no further than VinFast right now, which is probably the worst SPAC that we've ever seen. And you can read our piece. I'll put a link to that video at the end of this presentation. But look, there's no shortage of great companies to invest in. Don't bottom feed with SPACs. I mean, there's a lot of great growing SaaS firms out there that don't have these risks. So do me a favor, please click the Analyze logo on the right, subscribe to our channel, support it, and then I'm going to put up a video on the left that you might find interesting about that VinFast SPAC debacle. Thanks for taking the time to watch this today.